1. Meaning and evolution of money. Money is an important discovery that has made day-to-day transactions, valuing goods and services, as well as storing the wealth for future easier. We can buy goods and services using money because it is a commonly accepted means of payment, measure, and store of value. Evolution of money. Today we use paper notes, coins as money. Money has evolved over a number of years through various stages. Barter system. In the primitive stage, people exchanged goods for goods without the use of money. Commodity money. Later on the societies started using some commodities against which goods were exchanged. Metallic money. Gradually, the precious metals like gold, silver, bronze, etc., began to be used as money. Paper money. The metallic coins were unsafe to carry from one place to another. The legal tender is called as rupee in India, dollar in the USA, pound in England, euro in Europe, yen in Japan, yuan in China, etc. Bank money. As trade and commerce flourished, bankers started issuing instruments for still easy transaction. Plastic money. Very recently, the banks have innovated plastic cards known as the credit and debit cards, through which transactions and transfers of money have become still easier. Medium of exchange or means of payment. Money is used for selling and buying goods and making corresponding payments. Measure of value. The prices of all goods and services are expressed in terms of money only. Secondary functions. Standard of deferred payments. Money eases the future transactions too. Store of value. Since the future value is assured, money has made it possible to save or store wealth for future and help in its accumulation. Transfer of value. The introduction of money has made the exchange of goods to distant places possible. Banks play a vital role in the development of trade, commerce and other economic activities in a country. Importance of banks. Banks play an important role in economic development. Reserve Bank of India. Reserve Bank of India, RBI, is the Central Bank of India. Monopoly of note issue. RBI has the monopoly of issuing currency notes of 2 rupees and above, namely 5 rupees, 10 rupees, 20 rupees, 100 rupees, 200 rupees, 500 rupees, and 2000 rupees. Bankers Bank. It also acts as the bank for all banking institutions in the country. National Clearing House. RBI acts as the clearing house for settlement of transactions across banks. Controller of Credit. The RBI regulates the amount of credit issued by the banks, according to the monetary situation of the country. Custodian of Foreign Exchange Reserves. The RBI is also the custodian of foreign exchange reserves of the country, through which it manages the foreign exchange rates. Promotion of banking habits. The RBI promotes saving through branch expansion of the banking system in unbanked areas and financial literacy programs. Regulation of money supply. Currency notes and coins issued by the monetary authority of the country form the money supply in a country at any given time. Quantitative credit control measures. The quantitative credit control measures directly affect the quantity of money available to the business and people. Bank rate policy. The bank rate is the rate at which the RBI lends funds to banks. Open market operations. Open market operations is the buying and selling of government securities by the central bank from and to the banks. Varying reserve requirements. Banks are obliged to maintain reserves with the central bank in two accounts. 9. Qualitative credit control measures. The qualitative or selective credit control measures affect the usage of credit for different purposes. Change in lending margins. Collateral security is required for obtaining any loan. Ceiling on credit or credit rationing. The RBI fixes the maximum amount of credit given to a particular use or sector. Moral suasion. Moral suasion is a method of persuading the commercial banks to advance the credit or reduce the credit to certain activities. Direct action. Direct control consists of the measures taken by the central bank against commercial banks and financial institutions when all other methods prove ineffective.